Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, February 16, 2017. You're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And as you can see, we had a little bit of a down day today, but not the type of day that tends to end these type of rallies. The market had every excuse today to put in a larger down day than they did. We had the transports down large. We'll talk about that later. We had the broker-dealers down, so the financials were down. The market was obviously down much more than it finished the day. So they certainly could have sent the market down a little bit further. And considering that it's options expiration week, which expires tomorrow, I am a little surprised that they didn't do that. But that does lead me to a conclusion. Well, I shouldn't say conclusion. It leads me to some clues that higher prices are still in the offing, and those higher prices could certainly be the 236.25 on this move. Higher than that remains to be seen. However, I think we could get to 236 or 236 and a quarter on this move, and usually these type of rallies don't end with a little bit of a down day and then follow through on the downside. They usually end with some kind of gap and crap where the market would certainly finish or start higher and then finish more towards the lows, having sold off on increasing volume throughout the day. That's generally what you would like to see in a market that's in a downturn, or that's about to turn, I should say. There's really not a lot to say about the SPDRs. If we go over to a 10-minute chart, you can see here that we made a low early in the morning, tried to stage a rally, failed, and made a higher low. And the higher low is as a result of really two things, in my opinion. The higher low, and this can be applied to any time frame, any chart. The higher low is a result of the lack of volume, and the lack of volume really signifies the fact that the market couldn't go down further. So in order to push the market below the morning lows, you really need to see, or would have needed to see, an increasing volume profile in order to see that break on the downside. And you didn't see that. But the second thing, and probably more importantly, is there's still a certain level of buoyancy underneath the market. And with that level of buoyancy underneath the market comes higher prices. And until we see a bona fide corrective day or trend change day, a gap and crap, or something on volume, then we're just going to have to wait it out. And that's the position that we're in. We've been here before. There's nothing to do. You can't buy the market up here. You have to wait for a pullback. This type of move is unsustainable. The only thing that would signify higher prices, in my opinion, other than maybe $1 higher than we are now, is if we put in some kind of a long sideways consolidation pattern. That would change my tune. But at this stage, we're looking for a pullback, but we're looking for higher prices first. Looking over at the IWM. Same routine as the SPDRs. The IWM was down a lot more than it was, or finished the day. Pardon me, I got tongue-tied. However, you'll notice something interesting, that the IWM came in to basically test the what now is resistance of the upsloping trend line drawn over from the monthly chart. That's this upsloping trend line. And you can see they tested the overside of that early on today, and then the market bounced higher and closed back above the old closing high, or the old high, pardon me, which we closed above yesterday. But you'll note, we did not close above yesterday's high. We talked about that last night. We closed near yesterday's high yesterday, but we did not close above yesterday's high today, and that does not mean we have confirmation of higher prices in the IWM. So that's of note. It's not the greatest indicator in the world, but it's something that we need to take note of, put on the table. It's a piece of evidence. It's a clue. We want to know about it. Outside of that, not a lot of change from yesterday in the IWM. The VIX, we might as well talk about the VIX since we've been discussing the VIX the last couple of days, or at least did yesterday. You can see here we had a nice spike higher early in the day, and then the VIX collapsed in the afternoon. We finished below the 50-period moving average. I don't know if that means anything or it doesn't. However, it's just interesting nonetheless. We did see a real good spike up early in the day near $13, and then we fell back down. So we'll see how that takes shape. I expect, us to get a better read after we pass through options expiration, which expires or comes to the conclusion tomorrow afternoon, Friday afternoon. So after that, I think some of the dust will settle, some of the smoke will clear, and we'll get a better indication of what's next on the horizon. I do expect us to get to that higher price in the spider sooner than later. Looking over at the transports were the worst performing sector today, or worst performing index. And in fact, it was down much more earlier in the day. And you can see, I'll bring up a 10-minute chart, and you can see here that we peaked below the 200-period moving average on the 10-minute chart, but found support right around the lows from the 14th, which was Tuesday. And then we caught a little bit of a rally or a bid into the afternoon session. When you look at the hourly chart, you can see we were making a bearish pattern, but then in the last hour of the day, we popped up to close right underneath or on top of the 20-period moving average based on the hourly chart. But this was setting up to go lower, and I thought we had a chance to get down below the 50-period moving average based on the pattern. But that didn't happen. Why? Most likely low volume, light volume, lack of volume. The lack of volume, the tendency is for the markets to have the path of least resistance to the upside. That's just the impact of light volume. All in all, still a waiting game. Nothing wrong with the transports, still nearing or hovering around the all-time highs, or the highs from yesterday, I should say, which was at 95.66. We're not that far off. Next up, we'll go over to the gold market. And gold came in to test the 1244 today. The high was 1243.70, fell back down a little bit, but there's nothing wrong here. This is a bullish position that the market's in. Now, tomorrow, if we get another up day in gold, we could certainly see them bust through the old highs. That would be a bullish sign, but again, I'm not sure that we can get to the 200-period moving average or the 1275 level on this move. I would think we need more of a consolidation period. What I'm saying is gold needs really to eat more time off the clock to get up to that target of 1275 on the upside. Anything's possible. It certainly could happen. I just suspect that if we get through the old highs tomorrow, I'm not sure it's going to be a long-lasting rally in gold. I think we may fall back down. But anything's possible. Right now, it's bullish nonetheless. Nothing wrong with gold. No reason to be anything but flat or long at this stage of the game. So nothing's changed from yesterday. When we look over at silver, same thing. We now closed above the 200-period moving average. Again, we continue to edge higher. It's more like a trend following, day after day after day, or in an upswing on silver. And that's really the way it is. It's just a trend following series of updates. I mean, look at this. This channel really dates back all the way back here. I mean, this has been with one hiccup along the way, this has been some channel, right? And that hiccup really was to the lower portion of the channel. Now, my lines don't do it justice. If I did this correctly, it would look more appropriate, even though we may have busted through the lower portion of that channel slightly, but that's pretty phenomenal in terms of a channel. This will end badly at some point in time, but right now, back and forth, up and down is certainly where we are. And until we break the bottom side of this channel and confirm, and that'll end badly like this, but not anytime soon. Doesn't have to end anytime soon. It doesn't have to end for 6 months. It doesn't have to end until it ends. We don't have to worry about the ending. But this is in a nice, there's a channel inside of a channel, but real nice. Higher prices are certainly possible, but you would think that this is certainly an overbought condition on a short-term basis, would need somewhat of a pullback in order to reach that $19 level. That's my take on the situation, but I wouldn't advocate being short nonetheless. Looking over at crude oil. Same deal in crude oil. Still remain in the middle of a range. We had a slight update today. We're above the 50-period moving average. At least maybe we're busting out of the trap that's in between the 50 and the 20-period moving average. And if we are to the upside, then we'll see 54 in short order, maybe tonight, maybe tomorrow. We may make an attempt to break out of this range, but has to get going on the upside, have to absolutely get a daily close at minimum, and then a second one to confirm above 53.79 in order for us to get going on the upside. That is the critical level. Nothing's changed. Nothing's changed from yesterday. Nothing's changed from the last several sessions in crude oil. We remain in the middle of a range, making a long-standing bullish consolidation pattern. The long-term view from the pattern we're in, from the weekly chart perspective, is higher prices, $59 to $60 in crude oil. But we can certainly banter around in this range for quite some time before it gets going on the upside. But eventually it will, and we know that the first order of business is a close above 53.79. Looking over at the bond market, finally saw an update in the bond market, and we talked about this yesterday, that I thought maybe we would get down to the 149, but thought that it would be putting in somewhat of a low, and we challenged the moving averages on the upside, couldn't close above the 20, but did above the 50. But it was nice to see the reversal nonetheless. I'm looking for some follow-through. I think we will get some follow-through. And if we do, then this may be yet again another higher low. And if this is a higher low, that may set the stage for higher prices yet again. And what I mean by that is if you look at the higher lows, we had a low, we had a higher low, and if we could potentially put in another higher low, that would set things up for higher prices going to the upside in the bond market. I am expecting higher bond prices, lower yields, despite popular belief or popular media opinion, if you will. But, I just go with what I think and what my analysis tells me, and I pass that on to you. You make your own decisions, obviously. But based on what I think there's going to be one more push higher in bond prices, potentially up to, let's call it the 160 area. We'll refine that if we get going on the upside. If we can get that going on the upside, that may present a really, really interesting and wonderful shorting opportunity. But I think that's I guess, an opposing opinion to popular belief, and that's okay. It's what I think is coming. It's what my work tells me, and we'll see what happens. If I'm wrong, I'm wrong. I don't think so, and we'll leave it at that. So we'll go over to the dollar, and the dollar saw exactly what we talked about yesterday. We did it all in one shot. Could have taken 3 or 4 days, but nonetheless, we traded back down to right around the 20-period moving average off of that trend change signal yesterday, stopping at the 50-period moving average. The dollar did put in a pseudo doji candle, sign of a trend change. It was the 10th day from the recent pivot low, and today was a pretty nice healthy down day, traded near the 20-period moving average. Should come as no surprise. Doesn't mean there's anything wrong unless we trade below and close below the 20-period moving average. Then something else may be going on. But right now, this is a normal garden variety pullback. Let's see what happens over the coming day or days. And with that, I'm going to wrap it there tonight. The quiet markets create shorter videos. They are what they are. I don't need to bore you with a bunch of rhetoric unless I have something meaningful to say. And with that, I'm going to wrap it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.